we don't often see at the scale that we invest in of kind of like this early stage of say like 3 to 5 million ARR companies, the brand has not been professionalized. It's still scrappy, nascent. I think that's okay at this small scale. But when you get to an 8, 9, $10 million ARR company, there has to be this professionalization of the brand, this like natural maturation of how the company is positioned in the market. What does the brand look like? I think you can get away at the early stage of not having a super sophisticated brand, but definitely as you scale and you grow, it matters so much in being able to scale your go-to-market to invest in having that polished brand.
Hi, welcome to SaaS Half Full, the only show serving B2B SaaS marketers. I'm Lindsay Groper, EVP at PanBlast, and I will be both your host and bartender today. I had a great conversation with Michelle Erickson, who is the vice president at Straylight Capital. We dive into a really interesting conversation about the commoditization of entrepreneurship, specifically with software founders, and how marketing oftentimes can be a differentiator when you're looking at deal A versus deal B. So if you care to, grab a drink and join me as I speak with Michelle about all things software entrepreneurship and investing. Hey, Michelle, welcome to SaaS Half Full.
Hi, Lindsay. Good to see you.
I'm so glad you're joining me. I know we tried to actually sync up in person to do this thing at a conference in Indianapolis, but our schedules didn't align. So I appreciate you at least sticking with us and meeting me virtually. Great to meet you.
Absolutely. Great to meet you as well. I know that was a bit of a whirlwind conference. It was very busy.
Yes. And where are you based?
Ann Arbor, Michigan. Our firm is out of Ann Arbor and Detroit.
Perfect. Well, we are both sitting in the Midwest, and I understand we did get you a drink kit. It made its way to you, but you have a bit of a chaotic week in the office today, so you're not able to enjoy it right now, but hopefully later.
If it makes you feel any better, I'm drinking seltzer water out of a nice cocktail glass, and I look forward to enjoying a cocktail on your behalf this weekend. So thank you for that kit. Yeah, I was running out the door this morning because I have a little one at home, and my husband is traveling for work. So I've been solo parenting for a couple of bedtimes here, and yeah, a little chaotic.
Yes, that definitely equals chaos. Well, I always stick true to the process. So I am going with a ranch water, which is a version of a seltzer. And I've actually not had this one because somebody brought it to my house and left it. It's like
what flavor is it?
Margarita style. I don't know. It's a ranch Rita. For those of you that are watching, which is very few of you, most people are audio only, but I will be enjoying it. So cheers. Thank you for being on the show.
Cheers. The running joke in the office is that I love chili Millies, i.e. Miller Lights.
Oh, wow. I have a really good friend that is I think he's like the Miller Lite king of the Midwest. So maybe you're
I need to meet this person.
Yeah, it's on constant with him. That never have to guess what he wants to drink. It's that. Brian Werney, I'm talking about you. Well, I was excited to have you on the show because when I started to do a little bit of research into potential guests, I came across what I thought was a really interesting post that you had done recently with Start Midwest that was talking about the commoditization of entrepreneurship and specifically software founders. My agency works with all B2B SaaS companies, and so the topic sparked my interest. I dove into it and wanted to just explore it more. So we're going to be diving into that quite a bit, and even more so into a section that you talked about, which was sort of outside of the hard numbers and KPIs, is you also, like, secondarily, when you're looking to invest, look at this sort of vibe check with the founders. And so we're going to dive into that. But before we do, I wanted to give our listeners an understanding of just your background a bit, who you are, how you made your way to Straylight, if you were always in the investment landscape, or did you start out on the corporate side? So give us a little insight into history, and then currently what you do at Straylight and for what your investment portfolio looks like.
Absolutely. Well, thank you again for having me. I'm thrilled to be here. I hope that my background and experience lends well to those that are listening, because I was actually on the operating side before joining Straylight as an investor in go-to-market, marketing, and advertising roles. So I actually started my career in the nonprofit space, which not many people, I think, that are sitting in a founder seat or an investor seat often say. But I like to think that being at a couple of nonprofits has a lot of similarities to being at a startup, an early stage startup, because you're working with limited resources, you're working with a small team often, and you're having to be really, really scrappy and really resourceful. But I ended up working for a venture-backed startup that we planned mass participation cycling events and did a lot of new market entry initiatives. We had the DC bike ride. We launched the Dallas bike ride. I worked for a public affairs firm where I was in a kind of customer success type role, working very closely with our clients as well as our product team. I went to business school at Michigan Ross. That's kind of what opened my eyes to the world of finance and investing. So being able to bring kind of a marketing lens where I was director of marketing for Capital Sports Ventures. I was actually director of marketing for Michigan Athletics for a while. And then I got into the space of entrepreneurship. I started building kind of a networking community within entrepreneurship here in Michigan. And I ended up working for a summer with a wonderful early stage firm here in Michigan called Detroit Venture Partners, which is part of the Dan Gilbert Rocket family of companies group that invests in companies coming out of Detroit and often kind of overlooked founders, and worked for a company in their portfolio for a summer called Down to Ride, which is a cycling software business. I'm kind of a cycling consumer app. And then I worked alongside the MEDC, the Michigan Economic Development Corporation, and their outdoor innovation office to do a venture fellowship where we were looking at what are all of the outdoor related startups in Michigan, and can we make the case for there being an outdoor fund in the state of Michigan? And that work kind of led into the Michigan Outdoor Innovation Fund. And as I was wrapping up business school, I was looking for opportunities in this space. And it was kind of a right place, right time, and found a role with Straylight, which was formerly called Plymouth Growth. It was really neat because my position on the investment team here was the first kind of non-partner hire in addition to the team. So over the past couple of years, we've been able to grow our team and expand and build out the roles. And I've been able to kind of help build out a lot of our own investment processes around that.
You mentioned a couple cycling related gigs as well as doing marketing for Michigan Athletics. Were you an athlete? Are you a cyclist?
I'm a former cyclist, which is hilarious to say that. We actually took our daughter for her very first bike ride this weekend, which was a lot of fun. But one of the first nonprofits that I had worked for is actually in the cycling space, the Washington Area Bicyclist Association, a cycling education and advocacy nonprofit in the Metro DC area. I got really into biking. I was on a local bike team. I raced cyclocross. I played bike polo. So a little bit, it feels like a former life. I don't do that anymore. But that was a very fun time of my life. I still have fun in other ways.
I was like, connecting the dots. They said like the outdoor, startups. I'm like, this is and like.
I'm still involved. I'm on the advisory board and the investment decision committee for the Michigan Outdoor Fund today. So still able to lean into my interest and passion in the outdoors. Yeah. But I like to think that all of the kind of various roles that I held prior to joining the Straylight team and the various kind of operating, marketing, advertising hats, I do hope that helps me relate to many of our own portfolio companies in terms of scaling their go-to-market functions.
Cool. If you could tell us a little bit about the investment portfolio with Straylight.
Absolutely. So we invest in companies that are, I would say, somewhere in the middle. And what that means is kind of somewhere in the middle between venture capital and private equity. So we're partnering and backing often bootstrapped or very lightly capitalized, usually founder-led B2B technology companies that are, I would say, overlooked by this like traditional system of venture capital. Meaning maybe these companies are more capital efficient, maybe they're not growing 100% year over year, maybe they don't want to just follow that kind of raise and burn cycle. But we do invest across the country, and we're investing out of our Fund 5 right now, it's $125 million fund. So we're often partnering with companies that are between 3 and 13 million in revenue and that are looking to raise somewhere around kind of $5 to $15 million in growth capital. And our whole strategy is providing a lot of hands-on resources and kind of bringing your traditional private equity style resources down market to a much smaller company, a much smaller check size, but still being able to provide that like on-demand value creation to help these companies get to 15, 20 million plus. And we know what metrics the private equity buyer set is looking for. Yep. So we help these companies get in game shape for a future liquidity event or exit opportunity with a private equity firm or a PE-backed strategic.
Perfect. Thank you. I love the fact that you have a marketing background. I actually didn't realize that. So this conversation will be a perfect mix of the two. All right, so let's dive into the topic that we want to explore. In the piece that I read, and this won't surprise anyone, you mentioned that it's challenging to find software companies to invest in right now, and in part due to what you called the commoditization of entrepreneurship. So unpack this for us.
Yeah, so okay, this is a wild topic because I first heard this term, this phrase, and I wasn't necessarily arguing that there is a commoditization of entrepreneurship and startups. I was actually saying like there should never be. But I was trading emails with the CEO that I probably first met him 2 or 3 years ago at a wonderful venture software conference down in New Orleans, the Third Coast Venture Summit. And I've always thought his company and his business model was really interesting. And the company is like a little bit too early for where we invest. But I mean, one of our ways that we quote unquote source our own investment opportunities is just nurturing opportunities that are too small for us, but that we think could grow into a kind of a strike zone deal. We were trading notes and I was offering to make some intros for him. And I did make some intros for him to some early stage investors. And they, none of them wanted to take him up on the meeting. They were opting in. And I gave him that feedback. So I didn't want to just leave him hanging. And I said, like, it doesn't fit their mandates. And he was kind of saying, well, like there shouldn't be such strict mandates. That causes commoditization of entrepreneurship. And that comment in his email, I just sat on that for weeks. It really internalized to me, like, what did it mean? And I'm trying to find and pull and source meaning out of that phrase. And I was trying to make the argument that as investors, like if the CEO believes that mandates cause a commoditization of entrepreneurship, that's not going to help anyone. That's not going to help the founders raise. That's not going to help investors deploy capital because it's going to drive down supply. It's going to drive down valuation, drive down pricing. It's not good for anything. And then the other thing that's like really important about that is, I mean, I have never founded a business myself. I have worked at some early stage startups before, but there is so much skill, talent, resources, blood, sweat, and tears that go into building a company. Hopefully investors realize that. And that is not something that can ever be commoditized in my standpoint. And that there's so much value in the companies that these people, that founders are building. And you can't create a commodity out of that.
Right. Because commoditization implies sameness, things that are the same. But if founders are saying, okay, well, this is the box that investors need me to be in, then all of a sudden founders are all trying to squeeze into this one box and the box is only so big. So I really like this topic because thinking about, from the marketing standpoint, if we're talking about sameness, what are some things, like as a marketing leader for those that are listening, what are some like concrete ways that you feel like maybe a marketing org can help differentiate to investors, even if it is maybe a commoditized segment or vertical? What are some ways or what are some things that you have seen that have helped differentiate that are outside of maybe the hard KPI metrics that you typically look at?
Yeah, there's a lot to unpack here, I think, because you're asking if like what can marketers do? And it's interesting because from my perspective as an investor, we're often, the first couple of conversations we have are going to just be with kind of the founder or the CEO. And maybe that person is a marketer, maybe they're not. In my experience, they're often not like the true marketer. Although oftentimes the CEOs are often still like closing deals, leading sales. So there's this like differentiation, separation between like what is sales and what is marketing. But I would say we don't often see at the scale that we invest in of kind of like this early stage of say like 3 to 5 million ARR companies, the brand has not been kind of like professionalized. It's still pretty, like scrappy, nascent. And I think that's okay at this small scale. But when you get to an $8, $9, $10 million ARR company, like there has to be this professionalization of the brand. And there has to be this like natural maturation of how the company's positioned in the market. What does the brands look like? And like if I reflect on and think of some of our portfolio companies, and all of this is public information. Like I can absolutely share these companies because they're some of our superstars is that have these really strong brands that just come to mind. So a company that we've invested in, Close Simple, awesome group of entrepreneurs out of Minneapolis that have a company that does workflow automation for the buying and selling of homes process. So they sell into title and escrow.
Okay.
And they have created an incredible brand around Close Simple. It was pretty darn incredible when we invested, and one of their co-founders, Bill, is a brand guy, marketer, his background. So he does a lot of public speaking events, and they're able to use their really compelling brand. Like it's sharp, it's clean value proposition on their website. The story behind how their product has grown and expanded over time shows up really well on their website as well. And they're able to use that, I think, to get in front of customers really well and to close deals. And then another company that actually recently went through a rebrand that we are investors in is called, previously known as Medtelligence, now known as Alice, which stands for Assisted Living Integrated Solution, the Chicago-based startup that provides kind of a core like EHR record management, care management platform for the senior living industry for assisted living facilities. They had this really compelling brand that had been known in the markets, Medtelligent, for 15, 20 years, and realized they needed something that was a little bit more forward-looking. So they did a lot of work. I think they did work with an external agency to create this just like much more innovative, fresh-looking brand. The product was actually already called Alice, but the company's name was Medtelligent. They really leaned into like, we are now, everything is under the Alice name and brands. And their kind of slogan is around like looking forward. So those are, I think, two examples of where, I think you can, get away at the early stage of not having a super sophisticated brand, but definitely as you scale and you grow, it matters so much in being able to scale your go-to-market to invest in having that like polished brands. And then the last thing I'll add on that is, from an investor perspective, thinking about like how does the brand impact and inform a conversation between an investor and the startup? The brand is one of the first things the investors do see if they visit your website, if they look at any type of marketing materials, LinkedIn posts. And I think the brand is one of the first ways to inform market positioning for landing customers, and is one of the first things to inform value proposition. Like investors will always ask about value proposition because that's what creates value, like the inherent value to the customer. And if there's this like disconnect between your branding and your value proposition, there's going to be a lot of confusion there between the company and the potential investors.
Okay. One of the things you talked about was this vibe check that happens in the first 5 minutes of meeting a CEO. What are some of the signals, and this can be positive or negative, that you see within those first few minutes? And in your head, is there like a checklist, or is this just a general like gut feeling, right? But what are some of those signals that really matter?
Yeah, great question. There's definitely no checklist. It's very organic in terms of, is this a conversation that is enjoyable to have? Like I hope that in a first conversation, an intro meeting, I usually don't even think of it as a pitch. I don't want it to be a pitch. I want it to be just like, we are two people having a conversation about something that we do and something that we love and that we're passionate about. I would say things that impact me positively, does this founder, CEO, this person I'm meeting with, do they open the door for me to ask questions? I hate when those intro meetings are just like, here's my pitch, I'm jumping right in, like 30 minutes front to back.
Talking at you.
Yeah. Like I'm not ever going to pause for you to ask a question. Those are difficult conversations because I'm such a curious person. Investors, by nature of who they are and how they do their due diligence and understand an opportunity, are going to have a lot of questions. So if I don't get to ask a question on that intro call, I'm like pissed at the end of it, I would say. I think another thing is, and this is where it gets to the vibe check, is like, does this feel like a person that I can trust? does this feel like a person that is open to our kind of coaching and help? Or does this person seem like they have like their own playbook, their own agenda, and they only want capital. They don't want someone to actually kind of get their hands dirty and help them make improvements to the company. I think those are the things that impact me. I think on like the what not to do side, I would say I've had calls before where the person you're talking to, you might ask like, if it gets to that point, like trying to understand some of the quantitative metrics, because those ultimately impact and drive an investment decision. And if I ask a pretty basic question and they don't know the answer to like what their contracted ARR is, that's kind of like this is something that you should probably know. I would say that to them. But yeah.
The details. You mentioned you work with a lot of founder-led brands based on the size in which you invest. Many of them are founder-led, I would imagine, then when it comes to like brand voice and storytelling as well. Yeah. What's your take on the strengths and risks associated with being all in on founder-led comms?
Yeah, I would say the majority of investments that we make in the companies, it is still very much founder-led sales, founder-led communications and marketing. There's a lot that is good about that. I would say first and foremost, if your CEO is going to know the voice of your customer, we see a lot of companies where the CEO comes from that industry, or at least the CEO has like really intimate knowledge of that industry. So that's important because then they can talk the talk, they can walk the walk, they like understand, live and breathe the problem. So I think that's one of the benefits. When you have a CEO like that who is pitching the brand on a customer call, trying to close a deal, they're going to be able to get it done because they've built that brand. The brand has evolved from them. So I think there's a lot of strengths to that. I think the risks of it come when, from our perspective, like when your company that's growing to 8, 9, 10 plus million in ARR, that's looking to raise that next round of capital, or that's looking for some type of liquidity event around that stage. If you haven't scaled past kind of founder-led brands and marketing and sales at that point, I think that's where there's limitations there from my perspective. I'm not sure, like you probably heard about that from some of your other guests as well, where you do at some point need to be able to pass the torch. And that can be a really hard thing if you always just had your CEO closing your deals and developing your brand to be able to pass that off to someone.
Yeah, I agree. And at some point, if you are looking to exit, whatever that looks like, you have to decide, okay, specifically as the investor, is if the founder leaves, can the product, can the brand exist and have the same loyalty and same amount of renewals and same brand affinity if the person that was the brand is no longer there? So to me, that's a bit of a risk as well. If you want to exit and leave, then where does that leave the company? So being able to sort of see that in the future versus just like what feels good right now.
We have seen instances too, to your point, where after some type of additional capital raise, liquidity event, recap, exit, whatever it is, there is a rebrand and it's kind of away from that founder-led brand. And sometimes it works, sometimes it really doesn't work.
Yeah, I agree. The other thing that you mentioned in your piece was that in today's slower deal environment, that you feel like firms are widening their aperture. And what does that mean for SaaS founders? Do you feel that means that they are looking for different stories or maybe different like growth models in more of a sluggish economy? Or what are you hearing now?
Yeah, our execution team spends a lot of time talking to the later stage PE firms because those are the ones that are going to buy or do a majority recap or minority recap of some of our portfolio companies. So we want to know what they're looking for in the market so we can help with that maturation of the company and help facilitate that next step. It's funny because like I have heard that phrase from so many PE firms over the last 4, 5, 6 months.
Okay.
What that means to me, and this is like they're like using that phrase because they don't want to actually say and admit like we can't get a deal done, so we're like investing in things outside of our mandate. But that's basically what's happening, I think, across the board. I think venture firms are experiencing that too. And again, it's kind of goes back to like the commoditization, like the risk of having a really narrow deal box. Does that somewhat commoditize entrepreneurship? Because you're like, oh, this is only what I'm going to invest in and nothing else. So I think investors are being a little bit more creative and a little bit more opening the aperture to opportunities that they would not have necessarily said fits their mandate previously. And I think that is an extremely healthy thing. Because I think if we're, even from our perspective, we used to say, you know, this is exactly what we invest in. And now we're like, well, like, what if we are leaving opportunities on the table? Like, whatever that may be. So I would, you know, even at Straylight, we are looking at things that are just broadly B2B technology. So it can be SaaS software, because that's traditionally what is more easily scalable. But we've been looking at things that have hardware-driven software. We've been looking at things that are tech-enabled services. And I think as long as you can build a thesis around the scalability of the company and the durability of the company, I think that's fine.
Yeah, I see that as a really positive thing.
Absolutely.
So hopefully that will continue and there'll be more at-bats for sort of the more, I guess, I mean, well, they're not even non-traditional, but those that sit outside of that box.
I would love your take on this too, if you want to give it. But like, because being the SaaS full podcast, like there has been so much energy around SaaS companies, I think for the past decade plus. And I do wonder, like, do you think that by focusing all of the attention on SaaS, are we leaving out a lot of opportunity with these kind of still highly valuable companies out there?
Yeah, it's a good question. I was just talking to my managing partner about this too, just about in general, just the whole SaaS landscape, because, you know, we grew up, so did you, but we grew up with the explosion of SaaS and then went through COVID where everything, you know, got even bigger. But now, I don't know, I see AI as a threat to a lot of the SaaS companies and the SaaS industry as a whole. I think it's wise to not go all in on necessarily SaaS investing and specifically SaaS companies, and looking elsewhere, areas that AI is able to be more of a force multiplier for non-traditional, you know, software as a service companies. So it'd be really interesting to see what happens. Now I'm saying this, and I lead a PR agency and we're dedicated to working with B2B SaaS companies. So I'm sure my managing director is going to listen to this and be like, why are you shitting on SaaS? But we love the sector. We believe in it. But I do see some shifts in it for sure. Then now I'm going to throw it back to you from a crystal ball perspective. What do you see? And if you look at the maybe year ahead, the next 2 years ahead specifically with SaaS investing, do you feel just in terms of deal velocity, certain sectors, are there trends that you're seeing that you're going to come to play over the next year or so?
Yeah, that's a great question. Something that I think will be, say, our firm's catchphrase, and I like my catchphrase, if you will, for the couple of years ahead is durability. And I think what's important in that is, like, despite economic headwinds, market conditions, I think still feelings of a lot of uncertainty on kind of future growth and like, is our company going to be going up and to the right or not because of everything going on? I am hopeful that there will be more acceptance around the durability where, you know, I mean, building on what we were just talking about around like, why is SaaS so great? Like, obviously it is. There's a lot of things to be said about having that type of revenue model and business model because it is quite scalable and repeatable. But it's like, if you think about a tech-enabled services business, maybe they're more durable because maybe they're not burning as much on EBITDA. Right. Maybe they are generating EBITDA. Maybe they're able to cut the cash flow break even. I think that if things persist with kind of some of the economic headwinds, that there is going to be this return, or I hope that there will be this return to the sense of like, how do we make it through? How do we be durable as a company? And I mean, that's often how we think about our portfolio companies and our investment. And that kind of likewise, I hope that sense shifts up market to the larger VC funds, the larger PE firms. And I hope that they recognize the value. And I think that they do. We've been starting to see that. A lot of the bankers we've been talking to recently and buyers are saying how important gross revenue retention has become. Where a year or two ago, it used to be all about net revenue retention. But now it's about how do you maintain your customer base, not necessarily grow them, but how do you just keep those customers longer? So I think durability is going to be really important looking ahead.
Yeah, the tech-enabled services sector is really interesting, and we have quite a few of those in our client roster as well, as we're sort of called like SaaS adjacent, because they are, yes, historically durable. They don't have crazy client churn, right? Their big investments are lasting a long time, but AI now has allowed them to scale and grow so much faster than they were historically. So durable, but also now able to scale quickly and implement faster, but still have that longevity and client stickiness. So we're eyeing that sector as well for sure.
Yeah. And another thing that I think is somewhat related is the ability to recognize liquidity, so our firm have had a lot of success in the past year where we've seen, we and our management teams have seen 5 liquidity events in the past 4 quarters, which is like, there is not a lot of liquidity events happening. And from a VC perspective, there is not a lot of IPOs happening right now either, especially compared to a couple of years ago. Our whole strategy is predicated on being able to have a slightly short, like a significantly shorter hold period than truly like venture firms, where, if we can help our portfolio companies recognize liquidity, obviously recognizing liquidity ourselves, but if we can do that in 3, 4, 5 years and still have a very maintain and add a lot of value within our companies and be able to attract a market leading valuation multiple, take some of our chips off the table, help our management teams possibly also de-risk, and then partner with a firm that has a lot more resources than we do to help them with that next stage of the journey. Like, there is something to be said about a strategy like that, where you are recognizing some incremental liquidity versus like the typical venture strategies that we all know and that there's been so much interest in around kind of just like the raising and burning and hope that you eventually become big enough and important enough and known enough and recognizable enough to IPO. So I mean, they're 2 different sides of the coins. Obviously, it is very hard to do that, and the companies that do that are wildly successful. But I'm hopeful there'll be some more interest in kind of this other path of durability and recognizing more near-term liquidity.
Awesome. Was there anything that we didn't tackle that you want to make sure that we cover today?
I think the only thing that would be interesting maybe to speak about for a couple of minutes is on the perspective of like knowing that the audience is marketers and thinking about like the role that marketers play in fundraising conversations. I say from my perspective, oftentimes the first conversations that we have with the company are, the first couple might just be a CEO or a CFO. But then one of the like major next steps that we ask is to have a full meeting with the management team. And I think that's an opportunity where like, I want to hear about the brand. I want to hear about the plan for scaling go-to-market. I want to hear about how you show up and how you land customers. I want to hear about how you outcompete your competition. So I think like being able to say that and saying like, I always want to hear from the marketers of a startup that we're diligencing or possibly pursuing an investment in.
Yeah, and it sounds like that can be a differentiator. So if you have company A, company B, you like both founders, both relatively same growth trajectory, and one in that management meeting, one brings a marketing leader in who has a plan of attack, has done their research, seems to have what you need and what you're looking for. That could be a differentiator between choosing A and B.
Yes, I believe so.
Yeah, that's awesome. Well, thank you so much. This has been great. A topic that we haven't talked about in quite some time, just to the investment landscape, and certainly this idea of the commoditization is really interesting, and I'm glad that we talked about it. I ask all of our guests the same thing to end our show, which is if they have a signature or favorite toast to send us out. Do you have
That's a great question. I've been spending a lot of time building off of kind of like the durability and the role that we can all play in that. I've been thinking a lot about how we talk about challenges in our line of business a lot, but I think it's all about turning these challenges into opportunities. So I'm going to say cheers to turning challenges into opportunities.
That is so positive. Love it. Cheers. Thanks.
Cheers.
Thanks so much to Michelle for joining me on SaaS Half Full. I love that conversation. We have not had somebody on from the investment arm in quite some time. So hopefully as a marketer, you took a couple things away, maybe even how you can help prep your CEO for investor meetings and the role that you play and the founder plays in your comms and brand strategy. Really appreciate the listen. And until next time, bottoms up.